Welcome back, and joining us for a look at the day's markets action is Imtiaz Suliman from Sentio Capital. Thank you so much for your time, Imtiaz. Quite a lot that markets are digesting from a macroeconomic level. And I want to zoom in on China because it did return to inflation territory in February. Of course, after 4 months of deflation. Of course, inflation is not something that is good for a lot of countries, but deflation is also not good. Was this the consumer coming back, or was it the Chinese New Year demand showing off?
Hi, Xenatia. I think what we're seeing is there is a bit of effect with regards to the Chinese New Year. There was some inflation with regards to travel, food, and entertainment. And the trends over the last few months, as you mentioned, have been in deflationary territory. So it speaks to a Chinese consumer that is certainly lacking confidence, and the propensity to save is very high. We've seen the problems in the property sector in particular, and the Chinese consumer is very geared towards the property sector because that makes up a large chunk of the overall savings. So we'll have to see, whether this is a start of a new trend. I think what was a bit of a mixed picture in this result was that PPI, producer price inflation, was still negative, although consumer price inflation was positive. So input prices are still negative, and I think you need a few more months of positive CPI numbers to see if this is a start of a positive CPI trend.
Yeah, very, very interesting to note there the divergence that we are seeing with the PPI and the CPI. Let's come back home and take a look at some of the company news that came out of the JSE. Actually, starting off with Absa, which came out with results, their revenue increasing by 8%, but that not filtering through properly to the bottom line. We did have normalized earnings per share only growing 1%. Of course, not numbers that we have become familiar with coming out of the banking industry. Considering that loss in momentum between the top to the bottom line, would you say that share price slump of 3% was justified on Absa?
Yeah, I think if you look at it, it was a mixed picture with regards to Absa's result. And the mixed picture is really the difference between the performance of South Africa versus the performance of its operations in Africa. So South Africa came under quite a bit of pressure. We've seen some pressure come through in terms of credit card losses with regards to credit loss ratios increasing, vehicle asset finance, home loans. And this speaks to a very tough consumer environment, which is having pressure on those loss ratios for Absa. I mean, banks make money in two ways. The one is interest income. And if you look at it in Absa's case, net interest income was up by 12%. So that was quite credible. And the other way that banks make money is in non-interest revenue. And that was only up 1%. So we're seeing, transactional activity not at a level that is above inflation. And then overall, you have costs which grew by 10%. So staff costs still quite sticky, IT costs still quite high. And, putting all of that together, we've had pressure with regards to the bottom line. And that's why you didn't see that translation from revenue growth into earnings.
Well, actually, something that stood out for me today is Met's share price movement. It was up 25% when I read that trading statement. So the company expecting to swing from a loss to a profit in terms of headline earnings per share. It seems that they did develop some muscle in some areas, and they're also working on restructuring their debt, but still lots of macroeconomic challenges that have hit their numbers. I'm just wondering if this 25% surge in the share price, where that came from.
Yeah, so if you look at Met, I think it's one of the smaller cap stocks in our market. It's a bit illiquid from a trading perspective, and the share price performance year to date, prior to this move, was down 45%. So we had a big move up today. There was some comfort that the company is still profitable. They moved from a loss position last year to a profit this year. There's certain challenges in certain markets. So, for example, they have an operation in Turkey, which is affected by the high inflation that's prevalent at the moment there, and also a loss of exports into Russia because of the war with Russia and Ukraine. So there's some pressure on the energy vertical business. But if you look at the other vertical that they operate in, which is automotive components, that is doing very well. There were some challenges with regards to the ports and getting product into the factories, and that necessitated higher costs. But overall, the automotive components business is still doing relatively well.
All right. We do have to wrap up the conversation, Imtiaz. So let's get to your stock pick. What will it be today?
Yeah, I'm going with Alphabet, which is the parent company of Google. And if you look at it from a overall perspective, Google does dominate the search business. And from that business, they generate very good cash and earnings with regards to advertising, which comes at high margins. And then they've got some adjacent businesses with the likes of YouTube, the cloud business. Although you have big competitors like Amazon and Microsoft, the cloud business and storage space is still a very good growth vertical for them. They've got a strong balance sheet, which makes them immune to some of the macroeconomic noises that we see out there, and they can also use that to make strategic acquisitions, show up do some share buybacks and pay out dividends. So I think overall a very strong moat that Alphabet has, which sets them well for a difficult macro environment, but also to grow with regards to the IT world that we live in.
All right. Well, thank you so much for your time and for your analysis on what has been moving investors' money today. That was Imtiaz Suliman from Sentio Capital.